the move in bond yields. At this point, what's driving it? Because some of the fundamental data lately, I'm thinking consumer confidence yesterday has been a little better, and yet we continue to see these new lows on Treasury yields.
Well, frankly, there seems to be a race to zero in the global sovereign debt market, whether it's driven by the Fed or the ECB or what's going on in Japan. The fact of the matter is, U.S. Treasuries yielding even now north of 2% end up being a huge buying opportunity, and that's what we saw in the long bond, and that's why there's been this consistent bid for 10 and 30-year yields at this range.
And that's why the president is so upset this morning, just tweeting out that our Fed is not mentally keeping up with other central banks and that they're all giddy over the low rates that they have there, and we don't.
Yeah, there also seems to be a bit of a circular argument involved here, and that is, has Powell actually been setting the stage for the administration to push further on the trade war front? And that's a real fundamental question for the Fed. Should they be doing that? And if so, how does that play into the global outlook?
That's the Dudley view.
Yes.
Yes, Bill Dudley, former New York Fed president, causing quite a stir, saying to the Fed yesterday, don't enable the trade war.
Vinay, we're starting to see companies more and more reacting to this global trade uncertainty. We heard from both Autodesk and HP Enterprise. We're going to hear from the CEOs a little later in this program, both talking about the uncertainty, not so much from how it affected the quarter that they reported, but how it's affecting the outlook. How do you expect that kind of, I guess, fear about what might happen to affect these markets going forward?
You're quite right. Indeed, we expect this increase in uncertainty to cap equities. And as a result, we have decided to modestly de-risk our portfolios. The uncertainty is stemming from disruption to supply chains and also to investment plans of CEOs and CFOs. But it's a very modest reduction in risk. We are neutral U.S. equities, and our underweight is expressed in developed country equities outside the U.S., as well as emerging equities, which are more the focus of this trade conflict.
Vinay, and what needs to happen in order to avoid a recession next year? Is additional Fed easing enough, or do you actually need a resolution on the trade war to make you have a better conviction surrounding equities at this stage?
We don't expect a recession. It is more that we think the upside is capped while uncertainty is so high. If we did expect a recession, as you know, these recessions involve 30 to 40% corrections. We would have a far more defensive position in equities. We don't expect a recession because the U.S. consumer is holding up rather well, and that is also reflected in our intersector distribution of equity positions.
Which is what? I mean, where do you get exposure? Do you do the August playbook of the defensives with the utilities and REITs already at record highs?
We think the consumer is still quite strong, and therefore we have overweight positions in the consumer sector, both in basics and as well as in the communication services. Our underweights are in the more trade-exposed areas, and that would be technology, that would be industrials, and also energy.